The RBA have cut rates again, but the RBA governor has come out and said the housing crisis is not our focus and not our problem. So in this video, we're going to explore what has actually happened, where we think interest rates will go, and what are the banks actually doing as a result of the rate cut. We're going to discuss everything from supply to housing prices over the next 12 to 24 months. So if you're interested in my thoughts, definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. So I've been investing into real estate personally for 12 years. I've amassed a good portfolio and I'm happy with that. But for clients, we're purchasing anywhere between 20 and 25 properties every single week at Search Property. So if you're interested in getting help getting into the market, building a strategy from scratch, definitely go ahead and use the link in the description box below where you can book in a free call, and you probably would have seen a bunch of things from the website as well as over 300 reviews from clients. Now, the housing crisis is not our focus, Bullock stresses. Michelle Bullock has pressed on the ongoing rental crisis, and if the RBA had any reassurances for millions out there continuing to struggle, but she was quick to reiterate that wasn't anything to do with the central bank. I don't have a message from the Reserve Bank, but my personal reflection is that there's nothing that the Reserve Bank can do about these affordability issues of housing, she told reporters. This is an issue of housing demand and housing supply, and increasingly the issue is finding its way into both state and federal governments, and that's where the focus has to be. So she's basically saying, if the RBA comes out and cuts rates or hikes rates, we're just going to turn a blind eye to what the housing situation looks like. Now, in her defense, the RBA is supposed to look at numbers like inflation, unemployment, and GDP growth. Those are the main focuses for the RBA. But you can't tell me that you look at all of that data and then not account for housing. Because at the end of the day, central banks all around the world have changed how inflation gets calculated. They look at things like rent. Sometimes they take away rent. They look at housing prices, then they don't care about housing prices. And it's very, very confusing. Now, the good news is that we have seen another rate cut. So 25 basis points got cut off again from our cash rate. And that's important because if you've got a $500K loan, you're saving just under $100 every single month. Now that's in addition to the rate cut that we saw in Feb. So now we've seen two in a row. So what happens next? Well, I discussed what NAB is coming out and saying, and you should definitely go check out this video, bookmark it and watch it afterwards. It's so important that you understand what these banks are predicting, because that's going to flow on to whether they pass on these rate cuts in full or whether they're going to hold back. For instance, if a bank comes out and says, look, we expect 100 basis point cuts over the next 12 months, and it only happens to be 80 from the RBA, that means there's a high chance that they're going to pass on all of those rate cuts because that was part of their plan anyway. But if you have a bank that comes out and they're a bit more conservative and they say, well, we only expect 50 basis point cuts and there's 100, they might not be actually pushing all of the ones straight through to you as a homeowner. And that's why it's so important you have someone like a broker in your team, because they're going to keep on top of everything that's happening. They know exactly when banks are going in and passing on that full rate cut. And one of those examples is Macquarie Bank. From the 23rd of May, we're going to go and pass it on to our customers, whereas some of the other big four banks are waiting till the 30th. Now, while this may not be a factor alone that makes you change banks, it's just something you want to be aware of. Now, with interest rates being cut, as we know, and I've discussed on this channel numerous times, is demand will go up. But what's happening on the supply side? Because usually if you see interest rates go down, this could actually help the supply issue. But how bad of a situation is this at the moment? Well, the lower interest rates and stable costs are improving affordability and lifting supply, but Australia is on track to fall 262,000 homes short of its 5-year target. The National Housing Supply and Affordability Council says it's in State of the Housing System 2025 report. The 938,000 homes the country is forecast to build over the period to June 2029 is up from the forecast of 903,000 new homes, which is a positive. The federal government's advisory council made last year and reflects cyclical improvements in the economy, Council Chair Susan Lloyd-Hurwitz said. But the revised forecast still falls short by 262,000 of the 1.2 million new homes the federal government has pledged to deliver over the next 5 years. I saw a stat come out saying that we're going to be short in 10 years' time in Australia by 460,000 homes. That is incredible numbers. And we need something systematically to change, whether it comes from let's lower the demand, or we need to go out there and come up with new planning laws and reforms to go and allow people to go and build these homes. But a big factor that plays into this is construction companies. We have so many insolvencies, we don't have enough skilled labor in there to go and build these homes, and it's very hard for a building company to take on that debt to say build these homes. because that debt is now being serviced at a higher interest rate. So now if we're starting to see the easing pressure of interest rates and they start cutting, we might see a little bit more momentum when it comes to housing supply. The other thing that does happen as well is that when interest rates do drop, it allows the market to move with a bit more momentum, which means some people will actually now go and sell that house that they wanted to sell. But the effects of all of this is that housing prices will increase. Now, I know not many people like the fact that housing prices will increase and it's not good for the economy. You have to understand it like this, is as a builder, if I go in and say, okay, I'm gonna purchase land in this area and then I'm gonna go and develop. And for the sake of this argument, we'll say it's gonna cost me $1 million to get a house on this location. Unless the developer has confidence they can sell it for 1.2 or 1.3 million at the end of it, they're not gonna take on that risk. They might say, well, if it's gonna be $1 million today and I go and build this thing and then it's gonna be selling for $1 million, well then what's the point? I'm just not gonna build. So you actually need prices to increase over time and you need forward momentum in a market, because what that will do for the developer is say, okay, I can build this and I know I can sell it for 1.3. The person building the home or the customer is gonna say, well, that's fantastic because interest rates are gonna be lower, which means my borrowing capacity is higher in 12 months time, so I can go ahead and afford this property. Now, one thing that is gonna absolutely blow this market is going to be the incentive schemes and the first home buyer schemes that are coming into this market. You've got the government coming out and saying, these are the new schemes and for the 1st of July or the 1st of Jan, all of these things are gonna change. Unfortunately, this only goes and helps people that can do it on the day. So, for example, if I now have the ability to go and utilize one of these schemes and it comes into effect today, if I'm in a position where I've got a 5% deposit, I can go out there and borrow the money, I take advantage of that scheme today. But if I can only take advantage in say 3 months or 6 months or 12 months, well then everyone else has had advantage going into the same market I want to get into. They're using the same scheme, but 3 months or 6 months earlier. And that means demand in that market increases. And that means for me, I'm now at a disadvantage, which means by the time I can actually buy, the prices are much higher and I have to save a lot more in terms of a deposit. Now, while we focus on the pricing of homes, there is something that's coming out around the rental crisis. And just as we thought that maybe things would start easing up, if we continue the high levels of immigration, we're gonna have some major problems because there's no incoming supply or very little. And we encourage immigration and we know most immigrants coming into the country will rent first. Tim Gurner has come out and said, bad news for renters, the housing crisis has another 15 years to run as the nation's lackluster supply struggles to meet demand. Rents have soared nearly 40% since 2019, the year before the pandemic. And even though the pace of rental growth is easing, affordability has never been worse. Renters need roughly 1/3 of their income to cover their obligations. Now, there's always pros and cons to any moves that get made. We can see there's a cause and effect. If interest rates cut, is that a good sign? Maybe the economy isn't performing as the way we want it to. Then on the flip side, you've got people saying, oh my God, inflation is finally over. Inflation going down doesn't mean that prices are going down. It just means the rate of inflation is starting to decrease, which is a positive sign. But it still means that prices are continuing to go higher every year and the dollar value or the value of our currency is losing its value. So it's the debasement of currency. We've had Christopher Louis come out from SQM Research say that these interest rate cuts and where we're headed for the next 12 months means prices will be 8 to 15% higher. Now, just to put that into context, on $1 million property, that could be an extra $80,000 or $150,000. And on a 500K property, well, they're affordable properties and there's not many out there, but you would go out to say, well, on a property like that where there's more demand, you're probably looking at between 10 and 20% growth, which means that same 500K property could be worth 550 or 600 by the end of the year. This is why it's so important, and I urge you to really keep an open mind around this, is can you outperform the market? Can you get there before anyone else can? And what are you doing to put yourself at an advantage? Yes, we offer that service and I'm very confident about it, which is why I talk about it in these videos, because we do it time and time again. We go out there, deliver for clients, and we have the best sourcing team in the country. So go ahead onto Google, look up searchproperty.com.au, look at the reviews, find out if we're the right fit. Because that's what that first initial free call is about. It's to figure out whether we're the right fit for each other. At the end of the day, the market is going to move with or without you, and especially with or without me. That's why I'm so passionate about trying to help as many people that listen to these videos, watch these videos, and actually want to put plans into action. It is so easy, and I know this. It's so easy to go and watch these videos, get all this momentum, get all this confidence, and then not do anything 2 hours later. So this is an accountability for you. Get some runs on the board, start making that action now. And if you're in the zone to just continue learning, definitely go check out this video next because it's going to show you what my thoughts are around the 18.6 year land cycle and where prices could head over the next couple of years. I hope you guys have enjoyed this video. If you have, smash that subscribe button and I'll catch you guys in the next one. Thanks guys.